Okay, let's take a look at our review of the week, or what happened in the markets over the course of the last week. Before we look at the markets this last week, I wanted to give you a quick look at what's been happening to the global markets over the course of the month. Because ordinarily we talk about stocks and we say invest in May and walk away. Summers are pretty quiet, not much happens. The markets are usually, people go on vacation. There's not any big events that typically occur in the summer months, so it stays pretty quiet. But in fact, look at what's happened. We've had all this volatility, all this up and down movement in August. That just doesn't typically happen. And even more importantly, you can't get away from it. So you can see that the green line here is the S&P 500, so that's the U.S. market, very volatile. The yellowish beigey line is commodities markets, things like corn and soybean and gold, and that's been quite volatile. And then this gray line, a little less volatile, but still a lot of movement. That's the global stock markets. So when we look at this, ordinarily we're looking to see how do we reduce our exposure to a lot of movement. You can see this was a month when there was a lot of movement up and down, and you couldn't really get away from it because the markets were moving very similarly. It's not like when the commodity market is up, the stock market was down, and you can kind of counterbalance your risk. We just couldn't really do that over the course of this last month. So let's look at what happened over the course of the last week. So this is a market look at three indexes that we are going to follow. The S&P 500. The S&P 500 is the 500 largest U.S. stocks. The Dow is 30 as a basket of 30 stocks, and they typically are 30 impactful stocks. And then NASDAQ. And the reason we look at NASDAQ's the blue line, NASDAQ tends to be a little bit more volatile because it tends to represent tech stocks. And so when we look at this, at what happened over the course of the week, again, we can see there was a whole lot of movement. And what kind of movement did we have? Well, we started out the week and the market was up. This was the week when President Trump was at the G7, the global summit. And initially in the week, we thought, we're going to have good news about China and a trade deal. And so the market went up. On Tuesday, the market said, yeah, no, it's not looking so good, and the market went down. And then we saw it jump up because maybe it is going to be okay. Maybe the trade deal will come through. And then we had some not so great news about the yield curve, which we'll talk about in a minute. And oh gosh, looks like maybe the market is going to do okay, and we are going to get a China trade deal. And again, some more talk that we're going to get a China trade deal. So you can see that China had a pretty big influence this last week. It's not always that large, but it was a pretty strong influence over the course of the last week, primarily because the president was having global negotiations. So it made China have a much larger impact than typically. In general, the market was up over the course of the week. It started over here. I'm going to take that one too. It started here and it ended up around here. So it was up, depending on which market you're looking at, 1.8%, 0.9%, 0.8%. So the market was overall, it was up a little bit over the course of the week. Volatile, a good bit of movement. And the way we know about volatility, these numbers down here, this information down here, talks about how much stock was traded. So the higher the peak, the more shares were traded. And when more shares are traded, some are buying, some are selling. That typically is an indication of some market movement and some volatility in the market, and the market going up and down. And in general, volatility is more challenging for the market to manage, and the market typically isn't very happy when there's a lot of volatility in there. Okay. Now, one of the things that we're going to talk about is the yield curve. And if you pay attention to the news, you start to hear a lot about the yield curve. This is the important part about the yield curve. If you think about stocks, ordinarily what you would expect is when you invest in stocks that if you're investing longer term, you're going to make more money. For interest rate, if you deposit money in the bank, the longer you leave your money in the bank, the more interest rate you would expect, the higher the interest rate you would expect to earn. because you're locking up your money for a longer period of time. So if you invest in a savings account, you can take your money out tomorrow. You're going to earn a very small rate. But if you lock into a 10-year certificate of deposit or CD, ordinarily your rate will be higher. If you lock in for 30 years or commit to a 30-year CD, your rate would be higher. Well, what the yield curve inversion happens is that we have a period of time when the short-term rates, here the 3-month rate, is actually higher than the 30-year rate. What's going on there? The 2-year rate is higher than the 10-year rate. And why is that? Well, the reason being is that there's uncertainty about the future of the market. We can see that right here. So these are yield curves. When we think about interest rates, what we typically expect to happen is a pattern like this blue one, that the interest rates, the further out you go in time, because you're committing your money longer and longer, we expect to see what we call an upward sloping yield curve. It looks something like that red line I just drew. What we've experienced lately, July 27th, and again this last week, is we've had rates that have declined before they start going up. And that's called an inverted yield curve. So when the yield curve looks sort of like a U shape, that's an inverted yield curve. And what it signals is that the market thinks there's going to be some trouble ahead. And so they're expecting the rates to fall in a shorter term before it increases again longer term. In the past, since 1955, whenever we have a recession is usually preceded by an inverted yield curve. However, you got to be careful about that because we've had a number of inverted yield curves that haven't led to a recession. But we're watching for a recession because typically recessions happen about every 7 or 8 years, and we're about 10 going on 11 years since our last recession. So we're sort of overdue for a recession. Just because we have to have a recession at some point in time doesn't mean that that it has to be a big recession like it was in 2008, the Great Recession. But there will probably be some slowing of the markets at some point in time, and the yield curve probably is reflecting that. But just because the yield curve is inverted does not mean we're going into recession. It's an indicator, but it's one indicator and it's not always correct. This is another area that's a little bit concerning, is that if we look at our growth within the U.S., you see every fourth bar is the one of the quarters. So you want to look at every 4 to compare through time, and you'll see that our bars are not quite as high as they had been. This is an indication that we're seeing a slowing. We had higher growth in earlier periods, and growth is slowing down a little bit. I look at these things and I pay attention to when growth slows. But also remember, when you are a very small company, growing at 10 or 20 or 30% is pretty easy. As you get bigger, growing at 10% means a whole lot of additional sales and revenues and things. So the fact that the U.S. economy is slowing a little bit, I don't think is a sure sign of a recession, but it is an indicator as well. All right, let's look at some of the stories that happened over the course of the last week. All right. We have a group called the Business Roundtable, and it's a group of the top, I think, 200, 300 CEOs in the country. And the reason I like this story is twofold. Take a look at the end of chapter 1, and we talk about the goal of a firm. It's not to maximize profits, it's to maximize shareholder value. Well, what this group of CEOs came out and said, yeah, our goal really isn't to maximize shareholder value anymore, it's to take care of our stakeholders. And so when we talk about stakeholders versus shareholders, stakeholders includes the community that you live in, your customers, your suppliers, the government. So it's a much broader view of what the responsibility is for an organization. If you think about it, that would say that if you are located in a community and you discover that you could manufacture cheaper by building a plant in Mexico, you probably would reconsider saving money and going to Mexico because it would have a negative impact on the local community. Or that you would, if as a drug company, you would not take a product to market until you were sure no customer would ever be harmed. They usually bring products to market, and there's not a high likelihood of harm, but there's some indication. When we watch those TV commercials, we often see they give the whole laundry list of symptoms or side effects that could occur. Well, if you're really paying attention to your customer, you might not bring a drug to market until the side effects are very limited. So this particular story was very interesting. And when you look at our ethical dilemma for this module, you'll also see the ethical dilemma has to do with shareholders versus stakeholder rights. Big story this week, the opioid crisis. Who's responsible for the opioid crisis? And in Oklahoma, they had a case, and it was against a number of the pharmaceutical companies that manufacture opioids, one of them being Johnson & Johnson. A number of the pharmaceuticals that produce opioids settled out of court ahead of time. Johnson & Johnson said, we have such a small market share in this area. It's like less than 2% of all opioids are produced by Johnson & Johnson, according to Johnson & Johnson. And we really aren't at fault. So Johnson & Johnson went to court. And there's a couple of things that I think are particularly interesting. Johnson & Johnson lost the case, and the verdict was $527 million. So Johnson & Johnson, if the verdict stands, has to pay $527 million. Look what happened on the announcement. So here's this, we call this an announcement effect. The announcement came out and Johnson & Johnson's stock price went up. Why did it go up? Because the market expected they were going to lose the case and it was going to cost them over $2 billion. So the fact that they only have to pay $527 million was actually good news for the market, that it wasn't as dramatic as it could have been. At about that same point in time, Purdue Pharma, and Purdue Pharma is the company that produced OxyContin. They believe that their exposure to future lawsuits related to opioids is tremendous. And so what they are working on is a deal where they would create a fund of $12 to $15 billion, and they would put the company into bankruptcy. The current owners, the Sacklers, would contribute about $3 billion of their own money to this fund. The company would not actually go bankrupt. It would become a public trust. So then anytime profits come out in the future, they would go towards reimbursing those that have been negatively impacted by the opioid crisis. But the company in its current form would cease to exist. And what Purdue Pharma is saying is, let's do this deal and create this plan. And then we have no additional exposure beyond this. You can't continue to sue us. You can't come after the Sackler family further. And all future cases will have to come out of this fund because they realize that the impact of having created OxyContin and marketed it is so great. So that's Purdue Pharma's strategy in the opioid case. Johnson & Johnson, on the other hand, is still trying to fight future cases, and they have several more coming up. I think in Ohio is the next state that's going after Johnson & Johnson. All right. Okay, at one point, Altria and Marlboro were the same company. But back in the early 2000s, because there was so much litigation in the US around cigarette companies, Marlboro, which was the name of the company at that time, decided to spin off the global business from the U.S. business. So only Altria, which is the U.S. business, would be subject to additional liability with U.S. cases about people dying and because of lung cancer as a result of smoking cigarettes, and cigarette companies not disclosing how dangerous cigarettes were. So that happened in early 2000s, but now there's talk that the two companies are going to merge and come back together. And the reason they're doing it is a couple of things. One, in general, demand for cigarettes is declining globally. And that's unusual. It has been declining in the US for quite some time, but Japan and Russia and a number of Eastern Bloc countries have tended to have their cigarette smoking levels have continued to increase. However, what's impacting cigarette smoking? Fuel. So the electronic cigarettes have had a big impact, and part of the reason for these two firms to merge or recombine is Altria owns or has a large investment in Juul, so Marlboro will also benefit from that investment. In addition, Marlboro and Altria both own part of, I think you pronounce it IQOS. IQOS is the name of this product. It's an alternative smokeless cigarette that they're producing. And so by combining, they'll be able to share the profits in a better way. So they're calling this a merger of equals. And on the announcement, both companies' stock price drop. When the stock price drops, typically the market doesn't think this deal is going to create value. So we'll see if it's true or not. And, we often hear mergers occurring, and the reality is most mergers do not create value. In fact, they destroy value. Companies overpay when they acquire another company, and in the long term, shareholders are worse off for mergers. And here's a couple of big ones that occurred. And one of the ones, I lived through this, Sprint Nextel. My husband was an executive with Sprint during that time, and I watched the company destroy all kinds of value. The stock price dropped by 30%. They ended up writing off the entire value of Nextel after a period of time. But you can see Bank of America acquired Countrywide back in the savings and loan crisis. Countrywide was a horrible disaster for them. And the one that's most recent is Bayer Monsanto. They were just talking about this one this week. Almost the stock price has dropped almost in half since that deal was announced. So companies acquire another firm for lots of different reasons. Sometimes they do it because they expect some synergies or some created value. Sometimes they do because you'll see this with Apple very frequently. They'll buy a company that has expertise in an area that they don't have right now, so that they don't have to reinvent the wheel. They'll just acquire the ability to do something that a new company can do. So you'll see acquisitions for lots of different reasons. But know that when a company acquires another one, it's not always good news for shareholders. It often actually is not good news at all. Also this week, Peloton. So Peloton announced its plan for an IPO. An IPO is an initial public offering, and it's a company that's going to go public for the first time. Peloton is currently a privately held company. It has a lot of investments from investors, we call them angel investors, who put money into the company to help it grow. Now, Peloton's a privately held company right now, but they're expecting the initial public offering will generate $500 million. It's that big. They're going to do something called classification of shares. They're going to have A shares. So if you and I buy shares of stock, we would buy A shares, and those shares receive 1 vote for each share that you own. They're also going to create a classification of stock called B shares, and B shares get 20 votes for each share you own. So in other words, the B shareholders are going to be the leadership team and the founders, and so they're going to always control the company. And that should matter to you if you are considering investing, that you really are not going to be able to say, the CEO is not doing a good job, I want to fire him. You don't have enough votes to do that. So whenever you acquire a share of stock, you should pay attention to what the ownership structure is. Closely held firms are family businesses like Ford Motor Companies. The Ford family is still very involved. Ford has heavy ownership interest in that company, and they have extraordinary or extra voting rights, so that they control the firm. Under Armour, Kevin Plank is the CEO and the founder. He has all the voting rights essentially for that company. So if you buy shares of stock at a company where you really don't have a vote, you're saying you better really trust the executive team, because they're very much in charge. In 2018, the revenue for this company was $915 million. On that, they lost $196 million. So you may be saying, well, how can this company go public when it's losing money? And you can see that over here with this graph, how you can see the growth in revenues, which is the green, but you can also see the growth in losses. They're losing a lot of money. You'd think this is kind of odd, not unusual. Lots of startup firms will have growth with, and they'll be called. They're not accretive to earnings yet. They're still diluting earnings, or they're still losing money every quarter that they produce. The reason they can go public is it's a product that has a lot of hype. They are growing revenues. The revenues are going up there, and their subscriber growth is increasing. You can see it's half a million subscribers in 2018, when they only had 245,000 in 2017. Subscribers is important because that's a continuing source of revenue. So if you subscribe like Netflix, you're paying that monthly fee. Same thing with Peloton, you're paying a monthly fee. So we see this company that's going to go public, even though it's not making earnings yet, positive earnings. This isn't unusual. Amazon did not have positive earnings for, I think, the first 10 years that it existed. So it took a while before they became positive. There are companies, though, that go public and never have positive earnings and end up going bankrupt. It's a bit of a gamble, but we'll watch over the course of the semester. It should be sometime in September that this company will go public, and we'll see how they do. All right, so what's going to happen? What else is happening this week ahead? Really not too much. And part of the reason is we have Labor Day on Monday. It's a pretty quiet week. Everyone's just coming back to work. Later at the end of the month, we're going to start to see earnings announcements, and a lot of companies are going to report out on their third quarter earnings. We're going to see them start to tell us what to expect in the fourth quarter, and that's huge because fourth quarter is when most companies make most of their money. So the only real stories this week are construction spending's coming out. That's an indicator of how the market is going. If we see a lot of new homes being built, we would expect that that's an optimistic sign and people are expecting the market to do well. We're going to see one earnings report that I think is interesting, and that's American Eagle. The retail sector has been getting hammered, and we know how much we all shop online now versus in stores. And Old Navy has done poorly, Kohl's is doing poorly, Nordstrom's is not doing well. And so American Eagle is another one of those sort of a trending younger company, and we'll see how they do. My guess is it probably won't be a great earnings report, but we'll see. Employment numbers are going to be released. So is unemployment still at very, very low levels? Or are we starting to see unemployment numbers go up? And then, as I said, the earnings season is going to begin here pretty quickly. What I like are these graphs, and they're looking at different organizations and individuals and where do they think the market's going to go. And you can see it almost reminds me of the hurricane graphs we've been seeing all week on where Dorian is going to go. We got a big old range of what people are expecting from very good to not so good. So we may not know everything about stocks, but the experts don't know everything about where the market's going either. All right, I'm going to post this shortly, and here are the questions I want you to address. So what do you what's up with China, and why is it impacting the stock market, and how do you think it will impact the stock market going forward? Are tariffs important? Is that having an impact? I want your view of what you know about China. Now, I didn't talk about Brexit here, but Brexit is so important in the market, and over the next 57 days, I think we're going to see a lot about Brexit. Brexit is the United Kingdom's exit from the European Union, and so if you have been paying attention to Brexit, comment. Why do we care about what happens with Brexit? Why do we talk about it all the time when it's over in Europe as opposed to the U.S. markets? Then I want you to put yourself in the position of the CEO of Johnson & Johnson. Would you have taken a chance and gone to trial in Oklahoma? And or would you have tried to settle? And what are you thinking going forward? Are you going to continue to try these cases, or are you going to do something like what we saw with Purdue, where they created a fund? So tell me what you think and why, most importantly. All right, so we're supposed to have a recession about every year. It's been 10 years since we've had our last one. Are you concerned? What are you looking for to see if a recession is coming? So those are the questions I'm going to be posting for you to address. Good luck, and I'll look forward to hearing your answers.